if you're looking for a solid dividend stock, American Electric Power might be a company that you should take a look at. We can see over the last 5 years, it's only gone up 7%, which isn't exactly great. However, it was kind of at a peak, and if you would have bought around most of the time in the last 5 years, you would be significantly up. Also, 4% dividend yield is pretty good, and the last 5 years have kind of been an outlier. We see, even if we take highs in 2007 and 2000, right? Inflation since 2000 has only actually been about 90%. So this stock is dramatically or significantly outperforming inflation during that time frame, even in 2007. But if you bought during most of the times, right, most normal times, 2009 you would have done phenomenal, 2002 you would have done phenomenal, and most of this run up you would have too. The last 5 years is just kind of an outlier for this stock, excuse me. But yeah, near a 4% yield. So there's two types of dividend portfolios that make sense in my brain. There's one that kind of gets a 3.5, 4, maybe 4.5% yield, and the portfolio matches or ideally beats inflation, so you don't have to worry about, okay, do I have to set some of this dividend money aside? Am I going to run out, sort of thing? In that sense, you don't. There's also some dividend portfolios that are closer to 5, 6, 7% yield, which you definitely can do, right? But you're also going to have to factor in over a long enough period of time, maybe 10 years, it's not going to quite be returning what you want. It's going to return a little bit less, not like if you take all that money and don't put any of it back in. So I prefer the first one, right? So and American Electric Power fits almost perfectly. Like I said, going back to 2000, so for the last 25 years plus, I don't look much past 2000 because 25 years is so long. But since 2000, the stock has been outperforming inflation even at the peaks. So this is a pretty safe stock for that, and the dividend yield is closer to 4, so it's really not bad at all. You can see the PE is fairly low at 19, 17.3. You have to be really careful with PE for dividend-centric stocks because it's not really what's as important, because you're not really looking for like the share price of it. I mean, you can find outliers, don't get me wrong, and PE is still important, but it's less important in my opinion than share price performance over a long period of time plus the dividend yield. That's going to tell you more for dividend centric stocks in my opinion. Now, maybe you can really dive into the numbers, dive into all of its competitors in the sector, and okay, this one's cheaper than this one. You can do that. I have not done that. So if you do that, you're a little bit of a step ahead of me. Just for me, I really think that's a little bit in the weeds for me, but there's nothing inherently wrong with that, I guess. If we look at the dividend history, this stock, the dividend has been increasing and outperforming inflation significantly. So it seems to me, at least since 2016, they're trying to give more and more of the profit out through the dividend. So we may actually see that dividend, if this trend continues, get closer to that 4, 4.5, maybe even 5%, and you may stop, matching inflation with it just at this rate, right? And we can see that, right? Since, 2020, the last 5 years, hasn't grown as much, dividends a little bit higher. I'm not necessarily concerned with it. It actually looks like it's going to be a little bit lower this year, but not as super concerned. But so if you do have it in that first portfolio and it's like, okay, this is maybe not what I'm looking for, you could always sell. I mean, that would be something that would change literally over years and years and years. That's not something that's going to change really quickly. But also, I think I mentioned, maybe I didn't, that it's a utility-centric stock. I'm sure most of you picked power, right? But it is utility-centric, and utility stocks are actually really good for dividends because that's how it's easy for them to pay out to their shareholders, right? Because it requires a lot of debt and a lot of investment into it. So you don't always see the huge jumps year to year, like, oh, we're selling more of this, because it's what they're selling is really constant, right? Same with like you see it in Coke or Pepsi. I've done videos on those stocks. They're not really going to have, oh yeah, this product we're selling is like up 20%, like an Nvidia or an AMD, right? They either hit it out of the park with their tech thing and then they jump up, or maybe they do less. These ones are more consistent. Hey, we're selling to these people power, right? Pepsi, we're selling these people Pepsi and Lay's, whatever it may be, right? It's pretty consistent. So dividends are better for that. So it's not too surprising that this company, is utilities. So, and also they're up a lot because rates are a big thing for them. So it's the only slightly unfortunate thing is it's kind of bad timing, versus anything earlier than like what, October, something like that, September. But as a long-term hold, you really shouldn't be too worried about that. Schwab still thinks it's going to do really well. They reiterated that 7 days ago, so a week ago, that they think it's going to be the top 11% of stocks performing over the next year, I think in terms of share price. But even if you factor in dividends still, that's really, really good. Clearly it's better than 89% of stocks. It's borderline A, I believe 10% A. So it basically is, right? I don't do a 1 to 2 year outlook. I look, okay, long term, 3 to 5 years. This is a good company. This is a good industry. I think they'll do well. So I don't predict 1 year out. I just don't. But I do like this company. I don't own it, but it's on a short list of utility stocks I will own eventually, assuming things hold out. Right? Narrow economic moat. It's really complicated. We're not going to dive too much into it, but utilities, they definitely are their own beast. Let's take a little bit of a look of historical PE. Yeah, clearly earlier in the year it was cheaper because that's what we were looking at, but it's right within its historical margin. This isn't super cheap. It isn't super expensive, right where you would expect it to be. And then analysts are saying it's fairly mixed, but this isn't a blockbuster stock, so you aren't going to see like a bunch of crazy predictions on it. 7 of the 22 say buy, 12 say hold, and then a few say sell. So anyways, that's all I really got for this video, guys. If you enjoyed, I appreciate if you left a like and subscribed. I've noticed whenever people subscribe, YouTube's like, oh crap, people like this, and they recommend my videos out a lot. So if you enjoy the content, I do daily stock content on this channel. It really would help the channel a lot if you hit subscribe. But anyways, I appreciate all of you watching, and I hope you enjoyed. Catch you next time.